Hello. Good afternoon, everybody. Thank you so much for joining us. My name is Tyler Curley, and I'm a senior advisor here at Dahring, Cusmano and Associates. And we help people and organizations make more money by making smarter financial decisions. We like to surround ourselves with really, really, really smart friends. So I'm super excited to have a guest speaker on our webinar today, Mr. Jordan Segal. Jordan is a transactional attorney focused on mergers and acquisitions, commercial real estate, and entity formation and governance. Jordan recognizes that strategic deals and businesses do not happen in a vacuum. That's why he likes to adopt a holistic perspective that considers both immediate concerns as well as long-term impacts on operations, valuation, and scalability. Jordan meets his clients where they are, giving them accessible and understandable information and insights that they need to make informed decisions while sparing them from legal jargon. Jordan tailors his counsel to his clients, whether they are entrepreneurs starting their first venture, family owned businesses planning generational transitions, or private equity funds building portfolios. So, whatever your circumstance, Jordan's objective is exactly the same: to be the trusted advisor who does whatever it takes to clear roadblocks and get deals done. So, that being said, I'm super excited to introduce Jordan.
Thank you, Tyler. Thank you so much for that introduction, and good afternoon, everyone. Thanks for being here, and I know your time is valuable. So the fact that you're spending your lunch hour on succession planning tells me something important. It tells me that you're already thinking ahead, and that's exactly the mindset that separates business owners who exit on their own terms versus those who are exit on terms that are foisted upon them. My name is Jordan Segal. I'm a shareholder at Maddin Hauser. And I work with business owners every day on commercial contracts, real estate transactions, M&A deals, you name it. If you have a deal in the pipeline, I will paper it. And I like to say that my job is to help businesses make money doing whatever it is that they do. Um, I'm Tyler, of course, is with us today, and she'll bring sort of the financial planning lens and the financial side of things. And throughout this presentation, I'm going to turn it back. We're going to go back and forth between us on. I'll be covering, of course, the legal aspects, and she'll be talking about finance, sort of giving the financial picture that goes along with the legal points that I'm going to make. And I should point out right at the top, what I'm telling you is not legal advice. If you want legal advice, I'm happy to have you retain me. For now, this is just good information for you to have and help you plan your succession and get that process underway, but it is not technically legal advice, and I'm not your attorney, at least until you retain me as your attorney. So what we're going to do over the next 30 to 45 minutes is walk you through what a real succession plan looks like, how that succession plan will protect your business, protect your finances, protect your family, and we'll leave plenty of time for Q&A at the end. So here's right here is our agenda and what we're going to be talking about. You go back one. There you go. This is our agenda. So first, why succession matters right now, even if you're not actively planning on retiring or exiting, why you still want to get started on your succession planning as soon as you can. What succession planning actually is, and spoiler alert, it doesn't mean just picking your replacement or who you're going to hand the business off to. There's a lot more in that goes into that rather than just your replacement picking, although that is an element. What does the timeline look like? What are the options? And there are more than you think. We're going to talk about all the different types of exits you could engage in. We're going to talk about the benefits of early planning and getting ahead of what you want to do. We're going to talk about common mistakes, and trust me, I see all of these all the time. So it's a lot easier and cheaper for you to have you avoid making the mistakes than paying me to fix the mistakes once they're made. And then we'll open things up to for questions. Okay, so let's dive in. I will also say, do we have a chat feature? So if at any time you have a question, just throw it into the chat, and we'll find it and see if we can answer it for you. Okay, so jumping into the actual presentation, let me start with a few realities that I see in my practice all the time. I bet the majority of business owners, and particularly the people in this room, have more wealth tied up in their business than any other single asset. More than your house, more than your 401k, more than your brokerage account. Your business effectively is your retirement plan. And still, most owners don't have a written succession plan. And I think that that's a problem. And I don't want to be dramatic, but transition events, things that force a succession, don't wait for you to be ready. They don't come on a perfect schedule. I've seen owners who have healthcare crises. It happens that people get hit by a bus or a meteor or whatever. Um, Partners get into partnership disputes, and that blows things up overnight. Um, and on the flip side, something good may happen where you get an unsolicited acquisition offer. And if you don't have the infrastructure in place ahead of time, you have really no way to evaluate whether an unsolicited offer on your business is worthwhile or is realistic. So if something changed tomorrow, if you got hit by a bus, if you get burned out, if someone knocks on your door, um, could your business operate smoothly without you? And I want you to think about that. And if the answer is I'm not sure or probably not, that's an opportunity to get started because that's really the first step. Early planning doesn't lock you in, and answering that question doesn't lock you into things. It doesn't say that you have to exit according to your plan. Not written in stone. It's not a contract with yourself. You can always change things, but at least it gives you options. It creates leverage and continuity, and honestly, it helps you give you peace of mind, not just for you, but for your family, for your employees, for your clients. And so on that, Tyler, what is your financial perspective on the idea of early financial and exit planning?
Yeah, great question. Thank you so much. For many owners, the business is doing three jobs at once, right? It's producing today's income. It represents usually a significant part, as you mentioned, if not all of the owner's net worth. And then on top of that, it is expected to fund retirement, right? That's a lot of different jobs concentrated in one basket. And it's a very different form of risk than simply having too much money in one singular investment, right? I think especially as we talk about valuations down the road, it's really important to start these conversations early because oftentimes we see a discrepancy between what the business may sell for and what the owner's expectations may be for what that business may sell for. So if we get ahead of that and we start planning as early as possible, the financial plan ends up being more accurate and more robust.
So next slide. So what is succession planning? What are we actually talking about? Because I think a lot of people hear that and think, oh, who's deciding things when I retire? And that's part of it, but I'd say that's only about 10%. So from my chair, from the legal perspective, the first thing I always tell clients is remember that there's a distinction between ownership transition and leadership transition. And those are two very different things. You can hand over the keys to day-to-day operations without transferring ownership. Um, and on the flip side, you can transfer ownership and stay CEO or the chief executive. So these are separate decisions that need separate planning, and the timeline on both of those things could be very different, right? So you could imagine a scenario where an aging founder hands the reins over on decision making on operations, but stays the owner for a period of time after that, even permanently after that, in order to sort of get the ongoing revenue and benefits, financial benefits. And on the flip side, you could very easily see the reverse, where someone who's not ready to retire but wants to hand the ownership, wants to buy, sell out, and cash out, may well sell the business out, but as a condition of that sale, remain the CEO. And so I think you have to remember that those are, just because you're transitioning one, you're not necessarily transitioning the other. On the next side of things, you've got control and governance. So who has authority to sign contracts, who hires, who fires, who makes big capital decisions. If all of that is sitting with one person, and probably it's you, then something happens to you. The business doesn't just lose its leader, it loses its legal ability to operate. So it's, even if you had an employee or a second in command who is prepared to step up in your shoes, the documents that you have in place don't give that person the legal authority to do that. It doesn't matter that they're ready to do it; they can't. They're legally prevented from signing a contract on behalf of the company, and that those documents matter. You're gonna. So we're gonna hear in this area. We're gonna talk about buy-sell agreements. We're going to talk about operating agreements, shareholder agreements. These are the backbone of what your succession plan is going to look like, and what documents we're going to be either creating or amending in order to put that plan into place. What catches people off guard all the time are also, remember, your key contracts with your customers or vendors that have change in control provisions. So very frequently, your lease, for example, will have a line in it that says you can't transfer ownership and control, or at least if you do, that's a default of the lease unless your landlord has approved it. Bank loans carry personal guarantees. Professional licenses can be held individually and don't transfer over if it does. So making sure that we map all of those things out is how we execute a succession plan, and how we prepare for the succession plan. We get all of these things in order. We get all of these things documented and inventoried, so that we know how these key items get transitioned from the current generation, the current owner, to the next generation. And if you miss one of those items, it can be a real problem, because you can end up, for example, you have a business that can't operate because you don't have the proper licensure, or you all of a sudden have a lease default and your landlord says you owe me the balance of the lease. And that can be a real handcuff and a real albatross for a business. So Tyler, on this side, so on this point, what is the financial side of that?
That's a great question. And that's a really fun question and fun conversation to get into. Well, I say fun because I'm pretty nerdy. But from the financial side, I want to go back to that distinction, that what the business owner expects the business to sell for may not necessarily be exactly what it sells for. And then in turn, if we haven't done proper financial planning in advance, what the business sells for may or may not fund the business owner's lifestyle that they've been living previously. So very similar to, working with an individual that does not own a business. When we're planning for a business owner financially, whether that be simply a retirement transition, or as you mentioned, just a transition of ownership, we want to take a look and we want to make sure that we understand, what does the business owner's family spend? What income continues after the owner steps away? What other assets exist? It's really important, especially for business owners that are considering a transition, to introduce their advisor and their attorney very early in the relationship, because each has special expertise that can allow you the paths of least resistance. For example, there may be certain people who would benefit from a lump sum payment versus installment payments, all things that we need to think about as we're looking at the financial side. So what I'm trying to say ideally is that the financial plan nor the legal plan are something that we do one after another. They need to work together um, to make the most successful plan. And Jordan, I was thinking of a question. I'm curious from your perspective, where do you most often see the governing documents and the owner's personal expectations kind of pointing in different directions?
Well, the biggest problem I usually see is the governing documents don't exist.
Uh,
Particularly when you have a sole owner if you have a single member LLC or someone that running the business, the founder says, well, look, I'm the 100% owner. I don't need to have an operating agreement, or I'm the sole shareholder. I don't need to have bylaws and things like that. And to be sure, the operating agreement for a single member LLC or the bylaws for a single shareholder corporation are simple and short and sweet, but they should still exist. And as I say, that's usually where things start, right? So we look at when I'm doing this, the first step is to look at those documents and see what they say about ownership, management, control, tax, all the things that we're talking about. And it's important that even a single member LLC will have some form of guidance in the operating agreement, if it exists, about how equity is transferred, right? So frequently, I put into my operating agreements that equity cannot be transferred except to a personal trust or something like that for estate planning purposes, and as a way to protect the owner, to keep the equity all into the owner. And so, the first thing is a review of those sorts of clauses so that we know what needs to change. Even if we don't know how they're going to change, we at least have an inventory of what we're going to need to amend once we get there. And I think that's a great question, and it rolls into what I think is the key message that I'd like everyone to internalize, which is that succession planning is both business, legal, and personal financial strategy. If you only do one side of it, you're leaving a considerable amount of protection on the table. So now we're going to talk about timing. And I know 5 years out feels like a long runway. But this is where the value gets started. This is where we start creating value and we start protecting value so that when you sell or you exit, you're maximizing it at the end. So think of this rather than thinking of this as a 5-year runway, think of it as building by design. So what you're doing is you're building the business with your exit in mind, rather than, I'm leading up to this. This is all putting the business in a place where its regular operations create that value at the end of it. So 5 years out, we're not drafting documents yet. So we're not there yet. Maybe we have sort of a roadmap for what the documents look like. We have this inventory of what your operating agreements, what your governance docs look like, but we're not actually drafting the operative documents, the agreements that comprise your plan. We'll have a sort of a memorandum that lays out what that plan looks like, but we're not going to actually have the documents yet. And the reason why you don't want to do that too early is because things could very well change. If you build your second tier leadership who you plan to hand things off to, and they end up leaving the business or something happens to them, you've just paid me a bunch of money to draft a document for you for no reason. So let's talk about what are the types of things that we want to be looking at 5 years in advance. The first thing is to build that second tier, right? Who's your number 2? Who's your number 3? And if you're the person that every employee, client, and vendor calls first, that's a problem. And it's a problem because if all the goodwill of the business is wrapped up in you, if you leave, the business collapses. And it doesn't matter if you have a bajillion dollars in revenue. If you can't transfer that revenue to a buyer or to another party, it has no value to anyone other than you. And so no one's going to pay for it. So you want to be able to build that second tier of leadership, and you want to have them involved in the profit generation, and in the vendor contracts and in the client relations, so that if you do step away, either suddenly or by design, we have a mechanism to transfer those relationships to your new leadership team. You want to clean up your financial and your financial reporting. And so we're going to talk about all the different options in a little bit, but one of those options, one of the common options, is selling to a third party. And here's how that works in regard to here. Every time there's a problem with your financials, there's a problem with the due diligence, the buyer will come to you and say, well, we're still going to go forward with the deal, but because we can't have an assurance on this point, we're going to want a price reduction. And so the fewer opportunities you give them to do that, to retrade in that way, the better off you're going to be. So if you have clean financials, clean KPIs, clean documentation, it's going to reduce the ability of an ultimate buyer to retrade you in that way. And that ultimately means even though that nothing has changed in the value of your business, that your purchase price, the amount you've monetized from the business, we've maximized that. As I talked about, we want to reduce owner dependence. Every hour you spend making yourself less indispensable, you are increasing the value of the company. So I tell clients all the time that you want the owner of the business, in terms of their role as an employee, you want them to be as optional as possible, right? You want to make sure that you have another tier, you have another team that's in place that can take over if you have to leave, because that's how you value that. That's how you transfer that goodwill, and the value of all your companies. The more profit, the better exits are ones where the owner themselves has made themselves less, not more, but less indispensable, and more dispensable, I should say, to the business itself. And then finally, I think what we wanted, finally from the legal side, is we want to do a review and evaluate your corporate structure. Are you a C Corp when you should be an S Corp? Are you a Corp when you should be an LLC? These different forms of business have different features, and they have different tax benefits or costs. They have different authority lines. They have different governing documents, and how you want to structure that may well determine what your ultimate exit is. And some of that will also impact some tax benefits. So things like qualified small business stock, or the capability of taking advantage of a buyer taking advantage of certain tax structures or tax advantages, and being able to put those pieces in place 5 years ahead of time, may well mean the difference between a buyer hurdling a deal and not, because of a tax advantage they can realize or not realize. So doing a review of your entity structure is important. And I'll say this about entity structuring, other than the tax side of it, a lot of the taxes are sort of, if you're an LLC, you've got your LLC tax structure. If you're a Corp, you've got your Corp tax structure. And the tax code really evaluates that. But when it comes to the other elements, ownership, management, control, equity planning, we can do a lot of the same things depending whether or not you're an LLC or a corporation. We just need to sort of do it in different ways, but you get to the same place. And so I wouldn't be overly concerned about, well, I want to have this kind of management structure, and so I should be an LLC. We can replicate that on either side of that particular divide. We just need to know which way we're going. And with that, the next items you can see are financial, the personal wealth planning and insurance review. And so I'm going to turn it over to Tyler. So tell us about the personal wealth side and the insurance risk.
Yeah, 5 years out is a pretty critical time, because what 5 years out allows us to do is create options, right? So the first thing that we're doing when we're working with a business owner that is looking at succession planning is kind of what I alluded to on the last slide. We're figuring out what they are spending now what resources exist outside of the business and identifying any wealth gap that may exist. Um, the strategy in which we implement to close that wealth gap could change. For example, oftentimes we see that owners may not be utilizing their own company's retirement plan to the best of their capabilities. So we may suggest increasing their own contributions if allowed. So there are lots of things that we can do. I know Jordan mentioned that 5 years out seems like a long time, but in reality, it comes faster than you think. This is also when we start looking at insurances and more of like continuity planning. Um, Making sure that there's disability insurances in place, key person. We have key person life insurance in place so that, as we'll talk about later, not only is a planned exit accounted for, but an unplanned exit is accounted for as well. And Jordan, I think that you can attest to as well, the earlier the start, the more viable options we have.
That's absolutely the case. And in M&A work, what I like to do when I represent a buyer is run what I call I'm sorry, when I represent a seller, is run what I call a pre-flight, where before you've actually gone to market, I come at you as if I were the buyer's counsel, and run through an actual, maybe attenuated due diligence so that I know exactly what's going to pop when you actually get to a buyer's legal counsel and they're actually doing their due diligence. And hopefully, we've solved the problem ahead of time. And again, that minimizes those opportunities for a buyer to retrade and say, again, I hear it all, I see it all the time. You don't have a formal license, a formal license for this IP that you trade on. We're still willing to buy the company, but we're going to have to worry about that. We're going to have to buy insurance for that. So we're going to reduce our offer on the purchase by $50,000 to account for those extra costs. So if I had solved that problem ahead of time, that's $50,000 that they would not be able to retrade me. And that's a sort of a common process in transaction due diligence. So now we're 3 years out. 3 years out, we're starting to get closer to the actual event. And so we want to get more specific. So now we want to formalize management roles. So in 5 years out, we've identified those management roles. 3 years out, we're now formalizing them. We don't want informal understanding, someone who says, well, I've been working essentially as the CFO. No, if you're working essentially as the CFO, now you get that title. You actually are the CFO. You actually have those authority lines. You actually have that accountability. And you identify, while you're doing that, we're also going to identify our likely successors, or exit pathways. Are you handing off the business to family, to your management team? Are you going to market? We're not committing to an approach yet, but we need to narrow the field. So in particular, do you have a family member? Do you have children who are in the business who might want to take over? I mean, if the answer to that is no, then we can strike that off the list, and we know that we're going to be either looking at high level C-suite employees taking over, or we're going to market. Either way, you're going to want to create incentive plans for key talent, right? No one stays at a business forever, and having your employees be at will employees is a double-edged sword. It means, yes, you can fire them for any reason, but it also means they can leave for any reason. And so you want to start thinking about ways to incentivize key employees to stay. And that does a couple of things. One, I mean, if you have someone who is your institutional memory, then you don't want them to leave and you have to reinvent the wheel. If you have people who have developed as you have stepped back in that dispensable role and transition those relationships to your second tier, you want to make sure that they stay. Do you have restrictive covenants preventing them from taking your business elsewhere? those sorts of things. And on the flip side, do you want to start thinking about a stock option plan, an equity transfer plan, phantom equity or stock appreciation rights, or an long-term incentive plan? These are things that you can use to, the colloquialism, the euphemism we use is you tie your employees' hands with golden handcuffs, right? You give them such a nice incentive to stay that they don't want to leave. And frequently, that's a much stronger mechanism to keep your key employees in place than a non-compete could be. Business succession and estate planning need to talk to each other, and they need to interface. I can't tell you how many times I've had an owner client who had a great business transition, and then when it comes time to actually do something with that money, do something with the money that they did, they don't have a plan in place for that. So certainly, I frequently refer my business clients to my estate planning partners and vice versa, so that there's an interface. Once the money comes in, we know exactly where it's going. Is it going into a trust? Is it going into a family LLC? Is it going into a data protection, an asset protection trust, something like that? And then Tyler, why don't you tell us about initial valuation and benchmarking of a business and why that matters sort of at the 3-year mark?
Oh, yes. It's very important. And I don't I don't want to be negative or come off negative by any means, but I just want to keep reiterating that the headline valuation is a reference point. It is not a promise. And just like Jordan mentioned, there are many things that could come up during the negotiation process that could affect the overall price. So starting to do the initial valuation and the benchmarking 3 years out can not only give us an idea of what the business is worth, but it's also, to Jordan's point, going to identify what a buyer may view as a risk, right? So some of those things that he brought up before when he's playing good cop, bad cop with you, in reality is one of the most important things for the financial plan. Because we can make assumptions, but it's most important to take a look at anything that might be underneath the surface that we might not see financially. Um, yeah, I can't stress it enough how important it is.
Right. And that's so, we might find a valuation expert for your business. We might find something called a Q of E reporter. We might do any number of things that will give us at least an initial valuation of your business so that we have some base level to compare things to as we go forward in the next few years. Next slide.
And I will add to that when we're looking at financial planning that when we're testing assumptions, when we're looking at the business value, we want to look at net proceeds after debt, after transaction costs, after taxes, which we'll touch on later, and any portion of the price that may be contingent or deferred. So I don't want to forget about that.
Okay, so now we're 1 year out. So now we've gotten to execution. This is when the plan that we've put in place over the last 4 years, now we start actually executing it. Now is when we start actually drafting documents. The first thing is to finalize the roadmap. This is now in the form of a detailed, comprehensive plan. If you've ever gotten your estate plan done, you get these big binders with all the documents and all the memorandum and plan and things like that. Succession plan looks very similar. It's a different topic, but it's still that big book with a memo followed by all sorts of documents attached to it. The next step is to communicate selectively, and I'm highlighting the word selectively, to your stakeholders. You're not sending a company-wide email, hey, I'm retiring a year from now. This is one-on-one conversations with key employees, key clients, bankers, Tyler, me, your landlord, the people who need to be in the know and have a 1-year runway into the actual event. so that, as you go through the year and we need these people's communication and cooperation, you have it. So for example, like I talked about, in your lease, you may have an assignment clause that doesn't let you assign without landlord approval. It's worth going to your landlord ahead of time and saying, I'm not asking for it now, but just giving you a heads up. The business is going to stay. I'm exiting. We want to keep the business where it is. We have this clause. I just want to get you comfortable with it. I'll keep you in the loop as things develop. Nothing's happening just now, but I want you to give you a heads up. When you have particularly if you have a smaller landlord, if you have a big private equity landlord, who knows what they have their own metrics and things like that. But if you have, a small business landlord, they're going to appreciate the heads up and they're going to be much easier to deal with because you've kept them in the loop. And that same is true for your bank. The same is true with your employees. And the more you keep those key people in the loop about what your plans are, the better response you're going to get from them and the more cooperation you're going to get from them. If you show up and say, hey, I'm retiring tomorrow, your key employees are going to feel betrayed and it's going to cause a lot of friction. So it's a lot better to give them a long lead time. Now we want to talk now about the structure of the deal. Are we doing, if we're doing a buyout, are we doing it on an installment sale, a stock sale, an asset sale, a gifting strategy for estate planning purposes? This is where we start locking things in place. And we get a sense of some of that is going to be subject to negotiation with your buyer if you're going third party. But you really want to lock in how you want to do it. And that's going to inform your financial readiness if you have a internal buyout. If you're succeeding to your employees or to your C-suite, have they been to the bank? Do they have an SBA qualification? Are they going to be able to fund the buyout? It doesn't help if you say to your key employee, you're taking over the business, it's going to cost you $1 billion, and they don't have the money. Now you've just created a plan and it's unexecutable. So you want to make sure that there's at least some form of financial readiness and a financial plan on the other side for how they're going to fund the buyout. And in fact, I've seen, there are all sorts of options here. And I saw one recently where the company took out life insurance on the founder and used the proceeds from the life insurance to fund the buyout. So there are all sorts of ways that we can do this. The last item here, the relationship handoff planning, is personal. If you're one of the biggest client calls every month, if you're the person who clients calls, now we really need to transition that relationship. You can't do that on closing day. We need to start talking to your key personnel, your key vendors, and your key customers. Let them understand what's happening, introduce them to the next generation, so that it's not a one day, hey, I'm no longer the person you're dealing with, even though you've been dealing with me for the last 20 years. That's a recipe for, what you don't want to happen is you don't want your key customer to say, well, I've been working with Joe for the last 20 years. He's retiring. I'm going to start thinking about finding another vendor. You want that relationship in place. You want it to do a warm handoff so that relationship stays in place and it stays with the business. Next slide. Okay, so this is the one that everyone worries about. Everything I've talked about so far, everything that Tyler's talked about so far, assumes that you have time, that you get to choose your own timeline. That's not how things work. Life happens. Let me tell you what keeps me up at night as a business lawyer is that I have clients who are unprepared for the unplanned. For the death or disability of the owner, it happens. And when it does, if there's no plan, the surviving family, the surviving business is left trying to run something that they don't understand with no legal authority and no documentation about how anything works. burnout and health crises happen. I've had clients come to me and say, I need to be done with the business yesterday. My health is at issue. I just can't do it anymore. If there's no infrastructure, being done means fire sale pricing, shutting down the business entirely, and neither of those helps you financially. Sudden market shifts, right? If there's an industry, a new industry regulation, a new something happens in Washington that totally shifts how the economy works. Regulations change, or your biggest customer leaves. These are items that will fundamentally change how your business operates on a day-to-day level, and can, if you are not prepared for it, really undermine how your exit looks. And what we want to do under all of these circumstances is have something in place so that if the unexpected happens, if this thing happens, you have a plan so that you can be following a plan instead of trying to invent the wheel as you go, which is a recipe for losing money, losing clients, losing value, and so we don't want to do that. On the plus side, if you get an unsolicited acquisition offer, and this one's sort of the interesting one because it's sort of like winning the lottery, right? All of a sudden, someone says, I want to buy you out for a large sum of money, and it sounds like a good thing, but if you're not prepared, it's hard to negotiate from strength because you don't know what your value is. So if someone says, I'm going to offer you $5 million, how do you know your business isn't worth 10 million? And how do you know you're not just leaving items on the table because you haven't done the emergency and the unprepared planning ahead of time? And so, here the line on the side of the slide is, I think, really the important message, that urgency cannot replace lead time. It can't be the case that just because you have an emergent situation, you have an urgent situation that you need to respond to immediately. That doesn't replace lead time. So we have the lead time now. Let's put plans in place for these sorts of things to occur, so that when they do occur, if they do occur, you know what you're doing. An emergency continuity plan, even a simple one, is something that every business owner should have. And Tyler, why don't you tell us what that looks like on the financial side?
Financially, an emergency continuity plan really has to answer two questions. Is there enough liquidity, and can the right people access it when it's needed? So if we were coming up on this situation with one of our many business owner clients, we would first take a look at their life insurance, their disability insurance, their key person insurance to make sure that everything still aligns well with the risk of the business and what can be used there. And then the other thing that we do need to consider in an emergency situation is the business owner's family liquidity, right? Oftentimes, again, we go back to that problem of a lot of their wealth and potentially a lot of their liquidity could be tied up in the business. And oftentimes, if we're dealing with a situation where we have an unexpected transition, it's usually not very good for the most part, unless you get the lottery situation that you just talked about. So that actually, now that I'm thinking about our clients and I'm thinking about their buy-sell agreements, Jordan, when you review an existing buy-sell agreement, what are some of the key indicators, whether it's merely just there or it actually does everything it's supposed to do?
Well, so two things. The first important thing is, does it correctly and appropriately identify who's buying who and for what, right? So we have the parties and we have the value, either a flat valuation, it says that we agree the business is worth X, or some mechanism to provide that value. So I'm a big fan of something called baseball arbitration, where the parties pick values and there are rules about how you sort that out. You could have each side pick a person to be their valuator, and then those two people pick a third, and then you average the three out. I mean, there are all sorts of different ways that you can do it. The point is that you have some form of mechanism to provide that value. So that's on the one hand that you have that those terms in place. But the second piece that is just as important is the trigger. So what triggers a buy sell scenario? Is it someone wants to retire? Is it someone reaches a certain age and you have sort of like a mandatory retirement? Is it certain acts, right? So if someone creates, if someone sometimes we use it as a cudgel to keep people on the straight and narrow, right? Like, if you exit for a good reason, the value is X. But if you exit because you've been caught stealing from the business, the value is $1, that sort of thing. And so those are we want to make sure that those triggers are clear, that they are objective, right? So you don't want to have you don't want to have a trigger that's something like someone ceases to provide substantial value to the company. I mean, what does that mean? How are we measuring that? Those are sort of vibes that are hard to enforce in a courtroom or on a dispute. So we want to make sure that we have objective criteria, that we have clear trigger mechanisms, and what happens and to whom. That's how you draft a buy sell agreement. Okay, so now the next couple of slides are we're actually getting into what your options are. What are we going to be doing? What are the different types of plans we can create? And look, it's going to be the case that there's no one size fits all for any particular scenario, for any particular business. Not only do we, is option one or option three going to be different for different companies, they're also not mutually exclusive. And so, we have all of these three or four different options that we have for you. We can pick and choose features of each, and we can do maybe a partial family transition and a partial buyout and a spinoff. And so, what I want to go through are sort of these tools that you have. And then once we get into a conversation about what exactly it is that we're doing, we're going to, we'll sort of dig down and sort of bring out the pieces that we want. So the first thing is family transition, keeping it all in the family. And this is, I know a lot of owners want it to be this way. You built something, you built a fabulous business, and you want to pass it on to your kids or your relatives, and you want to see that legacy continue. And so the benefits of that are very clear, right? You have your legacy preservation. You have a continuation of relationships. Your clients know your family, your employees know your family. And so those sorts of things continue. And then hopefully an alignment of values. The culture that you built stays intact. And on a different conference call, I have a whole presentation about why culture matters to business. And we can get into that. Suffice to say, I'm a big believer that culture will very much is a determinant of your success. And just quickly, what I'll point out is if you look at college sports teams, they turn over every 4 years, and yet you have the same college teams perennially excellent. And the reason for that is not because they have the best coaching staff or anything like that. It's because they've developed the best culture and the culture of winning in that venue. And the same is true in business. But that's sort of a slight digression. Here's what I tell every client that comes to me who says, I want to sell the business to my kids, or I want to give the business to my kids. Your desire is not a plan. The first thing you want to make sure is, do your heirs want the business? And I see this all the time. Someone says, I built this huge business. I was going to give it to my son. My son told me yesterday he wants to be an artist in California. Those sorts of family dynamics come into play really, really fast. And so you want to be sure that you have someone on the other side who wants the business. But let's say you have more than just the one issue, the one family member that you're trying to transition to. You want to be fair among your heirs, right? So if you have 3 kids and only one of them wants to work in the business, how do you handle that equitably? Because if you're giving this huge asset to one child, the other two are going to feel very much left out. Do you have equivalent value to give them outside of the business? And if you don't, what's a way to split the business so that your more business-minded heir takes control of the business, but the other heirs maybe get a piece of the finances, but don't necessarily get a piece of the day-to-day responsibility or the day-to-day ownership and control. And so, and this is not just a sort of, I want to be fair to my kids question. If one of your children thinks that they're being treated unfairly, that may well go lead to a lawsuit. And there's nothing that eats up an estate faster than than a lawsuit between the beneficiaries. The next part of that is readiness and capability. And just because someone is your heir doesn't mean they're ready to run a $10 million operation. You have to have an honest assessment here. I know everyone likes to think their kids are the greatest thing since sliced bread, but you have to really say, is my son, is my daughter ready to take over the business? And I think that's super important. A family transition done correctly requires more than just communication. It requires documentation. Often it takes outside advisors more than any other option. It's the most emotionally rewarding when it works, and it's the most destructive when it doesn't. And I want to tell you an actual example. I had a client who is a second generation manufacturing company. It's about a $15 million in revenue. The founder wanted to pass it to his daughter, who's been running the operations for 6 years. So she's been running the business for a long time. It's a great candidate, but he also had two sons who weren't in the business. And so we spent a year working through an equalization structure, life insurance, real estate, deferred compensation package, so that all three kids got equivalent, even if not the same, without burdening the overall operating company. That family worked out very well. Everyone seems to be happy with the arrangement, but it's because we spent the time to plan and we didn't just assume that because one child was the business child, that child would get the business and that's that. We actually took time to plan out and game out how we're going to equalize that transition. Next slide. Okay. Option 2 is internal management buyout. And this is one of my favorite structures because when it works really well. It's sort of, think of it as the family business buyout or family business without the family. So the idea is your management team buys you out. The benefits are that your business continues with the people who already knows how it works. So there's no learning curve. They're the ones who've been running the business, hopefully, because we planned 5 years ago. Your clients, your employees experience minimal disruption because they're largely dealing with the same people. And we can structure this buyout over time with phased payments, earnouts, and seller financing that can have real tax advantages as well. So the challenges. I talked about this earlier, but to make it a point again, your management team probably doesn't have $5 million in their checking account. How do they pay for it? Are they going to be taking out an SBA loan? Are you providing seller financing? All of this needs to be structured carefully with your C-suite who are taking over so that they know exactly what they're doing. The pacing of the transition. How long do you intend to stick around? In what role will you be sticking around? With what authority are you sticking around? If you don't define these sorts of things carefully and clearly, what you'll end up with is someone saying, hey, I thought I was taking over. Now you've got two chefs at loggerheads, two people who might have legitimate cases that they should have the decision making, and they'd want to go in different directions. So that's what you don't want. That's why you want to have clear transition pacing and authority pacing in place. And finally, we want to make sure that during the transition, your key talent stays in place. They might get, this is when they're under more stress than normal. They can get recruited by competitors. They can get cold feet about a large transaction that they're a huge amount of debt. Our incentive structures here are really, really crucial. I talked about those earlier, and I'll give you a real world example that I'm working on right at this very moment. I have a professional services firm. It's about 40 employees with 3 senior managers who've been there 15 years. The owner was ready to retire, but he didn't want to sell to a stranger. So we structured a 5-year buyout, seller financing, an SBA note for part of it, a phantom equity plan that vested the managers with some gradual ownership as they hit certain revenues. And the owner eventually will get his price. The managers get a business that they know how to run, and we have so far not a single major client leaving during the transition, and a financial burden on the next generation that is manageable. Now, it doesn't happen by accident. It happens because we structure things right on the front end. And you could imagine a scenario where, leading up to this transition, one of those key employees says, wait a minute, I'm going to owe you $5 million. There's no way I'm going to ever be able to repay that. I'm out. And now not only have you lost your whole plan, and we've got to go back to the drawing board on what your succession plan is, but you've lost a key employee who's got relationships with your clients, maybe has knowledge about your intellectual property and your methods and the keys to your business. It's just walked out the door. So again, all these things want to happen. We want to make sure we do this carefully and appropriately. The next one is the big one. This is our third-party sale. This is where requires the most amount of work from me. This is the liquidity event option. And for a lot of owners, especially those without a clear internal successor, this is the cleanest and easiest path because you don't have someone internally that you're prepared to or capable of transitioning into leadership and ownership. So number one, the benefits here are you get the maximum possible liquidity. The best way to get the maximum value for your company is to take it to market and hopefully create a bidding war between multiple buyers and bid the price up. If you have a broader market value, a strategic buyer will pay a premium over what your internal people will pay because of synergies that you'd never be able to capture on your own. An example of this might be a manufacturing company may want to buy a distribution company and pay a premium over what that company is worth, because once it owns its own distribution network, it can absolutely save money on distribution. And so it's worth it to pay more for the asset for the company than it would be for someone internally to pay for it, or what the book value might be of the company. It gives you a clean exit. Once the deal closes, you're out. We'll talk about post-sale expectations, but by and large, you get your cash out and then you're done. The challenge is, I talked about this earlier, that retrade and the need for a pre-flight. That's the biggest. That's sort of the most prevalent under this option. Is the buyers will go through their own due diligence. They'll go through your business with a fine-tooth comb, and every contract, every employee file, every customer relationship, every piece of intellectual property. If there are skeletons, they will find them. Cultural fit is important here. I talked about culture before, and this is especially important with private equity buyers and strategic acquirers. Your employees will wonder what's happening. And I'll tell you a story that there was a business sale recently where they didn't tell their employees that they were selling out until the day before the sale closed. The employees found out who the new owner was and didn't want to work for them and quit en masse. And it derailed not only did it derail the sale, it derailed the business because they got no employees anymore and they had to shut down. So cultural fit is particularly important with a third-party sale. And then finally, post-sale role expectations. Most buyers are going to want you to stick around, particularly if you have a business that is tied to goodwill, because they're going to want to transition that goodwill. Um, uh, Sometimes you'll see things like earnouts, which are tied to performance. So in other words, the purchase price is 5 million. If you hit a trailing 12-month EBITDA target, you'll get an extra couple million, something like that. Those tend to be some of the most heavily negotiated and heavily litigated after the fact portions of a third-party sale. So I said it's a clean break. It's not always a clean break. Okay, next slide. And we're running low on time, so I'm going to sort of speed the pace up a little bit. There are two sort of final options I want to talk about. These are less common, but they're out there. A phased exit. This is if you step back gradually. Maybe you go from CEO to chairman. You work 5 days a week. You move to 2 days a week. You stay involved, but you mentor your successor and ease them into the next chapter. Of course, the benefit is continuity, but we also get the risk of that blurred authority that we talked about. And then finally, an ESOP. This is very rare. A full ESOP is usually highly expensive in terms of building it and in terms of compliance. So there are sort of other ways to do the same thing that's not a full ESOP, an employee stock option plan or ownership plan, but it is something similar where we have employees take over. This is where so your employees become the owners. It's phenomenal for retention because your employees who are now become the owners. They now have a piece of the pie. It's not right for every business. It's not right for every industry. It's not right for every scenario. It is an option. It's less common, but I do want to throw it out there. And again, here's the bottom line with all of these options. Is there is no one, I said it at the top, there is no one size fits all solution. We want to have that discussion with you individually, figure out what's best for your business, who the players are. This is why this is bespoke work, right? I'm not off the rack. I curate a specific plan for you. Next slide. Okay. Are common mistakes. Assuming there is plenty of time. There's not. There is not plenty of time. What is it they say? The days are long, but the years are short. These plans take years to execute, and they take years to execute properly. So the best time to start was last year. The second best time to start is right now. Confusing heirs with qualified successors. Your child may be a wonderful person and a terrible CEO at the same time. That happens a lot. An honest assessment is an act of love, not an act of cruelty. You don't want to put your children in a place that they're not ready to handle. Lacking a documented authority structure. If you get hit by a bus, who's going to take over? Who has the passwords to your bank account? Who can sign payroll? Who can buy the company? These are all important questions. Waiting until burnout to begin planning. By the time you've burned yourself out, you're going to lack the energy and patience to do this. This is going to be difficult and long term. We want to plan when you're at your best, not at your worst. And ignoring taxes until the end. Tax planning is not a last minute piece. It is something that has to happen along the lines as we go, and at each stage we want to evaluate tax consequences. And with that, I'm going to turn it over to Tyler to give a brief example of tax savings and advantages of tax planning.
Yeah, tax planning can be huge. It's hard for me to put an exact number on how much planning in advance can save in taxes because again, my work, Jordan's work is bespoke. It's dependent on the client. But what I can tell you is that the decisions that you make during this process can materially change, especially from a tax perspective, what the owner keeps. So, like Jordan, I'm sure you've seen a stock sale and an asset sale can produce very different results at the
A
end of the day.
hundred, 100%. And in fact, this morning, I was on a long conference call with a client, and my client is buying a business, and we are the biggest, most heavily negotiated question that we're engaging in is, will this be an asset sale or a stock sale? And the reason is driven by the seller wants to take advantage of some tax consequences, and we want to take advantage of some structural advantages. So it's absolutely that is one of the biggest questions that comes up in terms of tax planning. Okay, so three questions every owner should ask. And here this is sort of the end of the presentation, and I want to leave you with these questions. I want you to think about these things tonight, over the next few days, whatever. But I think it's important before we get engaged, before we start these discussions in your tax planning, these are important questions to ask yourself so you know where you want to go and where your gaps are. So the first thing is, what happens if I stepped away? Who would lead? Not who do I want to lead? Who could actually do the job today, right now, with the owner, with the authority and the knowledge and the relationships to keep things running? Who can do the job right now if you're hit by a bus tomorrow? I want you to think about that, because that's the person who we're going to use for your emergency plan. It doesn't necessarily need to be your long-term plan, but at least that's the person we're going to look to make sure that if there's a problem, that's the person who's stepping up. Two, if you wanted liquidity, what are your options? Could you sell tomorrow if you needed to? Would you know what your business is worth? Would a buyer be interested in the business in its current state? And how are you going to transfer the value of your company to them? So remember what I told you earlier. If the business is entirely your personal relationships and you have to step away, you have no way of transferring that value. So what I want you to think about is, if you had to transfer, how would you do that? How would you transfer that value and get the liquidity in exchange? And finally, if something unexpected happens, what's your plan? Do you have a plan? Is it written down? Does anyone know about it? Is it in your head? Remember, look, you could have the best, most detailed plan. It's in your head. You get hit by a bus, it does no one any good because no one knows it except you, and you're in a coma. We want to make sure that we have these things accessible to everyone else. And if you can't answer all of these three questions with confidence, that's okay. That's where we come in. That's where Tyler and I come into play, and we can help you do that. But it's important that we know where the gaps are, so we know what we need to put in place now, what we need to put in place 3 years from now, 5 years from now, and what we can do immediately for you. So thank you so much for your time. We've only gone about 5 minutes over, so I think we're doing quite well. Here's my contact information. You can always find me on LinkedIn. You can find me on our Maddin Hauser's website. Feel free to call me with any questions, even if it's just, hey, I saw your presentation, and I don't know how to get started. I'm happy just to have that chat with you. My suspicion is, once you and I talk about how that process will look for you, you'll hire me to do it.
Jordan, thank you so much. It is such an honor and privilege to be able to know you and be able to work alongside you. And you're just a wealth of knowledge. Luckily for these folks, we only went over a couple minutes and not a couple hours. So thank you
Well,
all again.
What I like to say when people say something like that is, I fooled the hell out of you.
You cracked me up.
All right. Well, thank you again for having me. I love working with Dom and Cusmano. I love working with Tyler. So this has been such a wonderful presentation to put together, and I hope to see all of you at future presentations, and I hope to work with all of you as your attorney.
Thank you, everybody. Have an excellent day.